Swayam Prabha. Digital India. Educated India.
Welcome to this session on commodity derivatives and risk management, and today we will be discussing the remaining part of gold derivative. And if you recall, in the last session we discussed about good delivery list and how exchange does not take responsibility of quality assessment with respect to the delivered gold, and there are identified refiners, or exchange identifies as some refiners whose gold can be accepted as a good delivery on part of the exchange. Now we will be discussing the different kinds of forward contracts and other OTC over the counter contracts which are signed by gold mining companies for mitigating their gold price risk. And what are these derivative contracts? These are your forward contracts, trimming deals, option contracts and collars. So we will be discussing little in detail about the forward contract, gold forward contract. And before we go to the discussion on gold forward contract, I want you to recollect the spot price movement of the gold price. If you recall, in last session I had mentioned that gold price remained around $300 to $400 per ounce for 10 to 15 years during 1990 and some early part of 2000, and 2002-3 onwards it started picking up. And let's go to this particular picture, which is shows the movement of the gold spot price, and this is the LBMA afternoon fix monthly average US dollar price per ounce of gold. So if you see during May 1991 till February 2004-5, gold was almost in the range of $300 to $400. So during this prolonged period of low price, many gold mining companies started entering into forward contracts to deliver gold at a fixed price for a substantial long period of time. And subsequently, when gold price increased, they realized the mistake on their part for entering into long-term forward contract over a long period of time, and many companies, many gold mining companies undertook something called a dehedging. So many times in this particular course I have mentioned hedge, but this is the probably the first time when we are talking about a word called dehedging. So what exactly dehedge and how companies go about dehedge, we will be discussing in the next couple of minutes. As I mentioned that gold mining companies sell gold at a fixed price for a at a future date as part of a forward contract. And as I mentioned, gold was prolonged a bear period during 1999 onwards, and many gold actually it will be 1991. So many gold companies in the world entered into the forward contracts to sell gold at a fixed price, and downside of the hedging became apparent when gold price started to climb up during 2001. and many of these gold mining companies de-hedged their forward position relatively at the earlier part of the gold rally. However, a company called Barrick Gold waited till 2009 to de-hedge. And what was the cost associated with the de-hedging? What kind of a repercussion of happened on the company? This is a very, very important dimension of gold hedging. And whenever we talk about gold hedging, definitely Barrick Gold's de-hedging case is also discussed. In fact, Harvard Business Review has a case on the de-hedging program of Barrick Gold, which very clearly describes about the amount of gold it entered into, amount of forward contract it's entered into, the price, and subsequently what happened. So if you can get access to that particular case study, it is worth reading. Now, if you if you see this particular slide, to de-hedge in the year 2009, the company issued $4 billion worth of stock to unwind its 9.5 million ounce of hedge book. So during 2009, it still had entered into delivering 9.5 million ounces of gold at a fixed price, and de-hedge comes with a cost. Now let's take an example, theoretical example, why de-hedging comes with a substantial amount of cost. Now so this is the Barrick Gold. Barrick Gold had entered into, let's say, during 2000, it entered into short forward contract for delivering or selling gold at a price of $550 per ounce, and this contract started in the year 2000 and it was, let's say, up to year 2010. So now let's say, suppose the price in the year 2000 to 2010 was the contract period. 2000 is during 2000, suppose the prevailing gold price is around $400. So Barrick Gold is very happy. This is the position. It has entered into a short forward position. So payoff for Barrick is going to be this line. So if spot price, this is the x-axis is the spot price, this is the positive direction, and this is the positive payoff and the negative payoff. Now if prevailing spot price is anything less than 550, Barrick Gold stands to gain from the hedge contract. Let's say during 2000, suppose the price is around $400. So in that case, Barrick Gold is going to be, this is the $400. So Barrick Gold benefit is to the tune of this. So for every 1 ounce of gold it had contracted to sell, it will be getting $150 per ounce benefit. Now similarly, let's say in 2000 the price is prevailing around $500 and it will be selling the gold at $550, so it is making a profit of $50 per ounce. Now let's go to the next year. Let's say gold price starts increasing and next year price goes to 2002, it is 600. So in that case, the loss to Barrick Gold on account of the hedge comes to $50 per ounce. Let's say Barrick Gold hedge is some year you are going to gain and some year you are going to lose. So Barrick Gold did not mind delivering gold at $550 when the spot market gold is selling at $600. Now let's say by 2003 gold price increased to $800. So what is the loss on account of the forward contract? For every ounce it delivered to the counterparty, it came to $250. So this is $150 gain, $50 gain, $50 loss, $250 loss. Now when it became increasingly, let's say, evident for the company that gold price is going to go up and up. Now if the company does not do anything, it will go on incurring higher amount of loss. So let's say in the year 2003, Barrick Gold decides to dehedge. So dehedge means in 2003 Barrick Gold is going to pay $250 plus the present value of the loss as if the gold price is going to be at $800. So if gold price is going to be at $800, so the loss is going to be $250, $250, $250, $250. So 2004, 5, 6, 7, 8, 9, 10. So remaining so many years, this Barrick Gold Company's loss as on today, that is as on today, Barrick Gold loss is $250 for during 2004 to 2010. Now what is going to be if it has to dehedge, or basically in case of your in case of a futures contract, suppose it had taken a short futures contract and it want to take a long futures contract. So exactly, now if it has to buy back the short futures position, so it has to pay to the counterparty. So what is going to be the present value of the payment? So this present value of the payment is going to be 2000 discounted value of 250, this 2004 to 2010, whatever the discounted value. So I have used a discounted rate of 4% per annum. So with this discounted value, this comes to 1500 for 2004 to 2010 plus this year 250, so that comes to $1750 per ounce. So to dehedge in the year 2003, Barrick Gold is supposed to pay $1750 per ounce of gold it had agreed to deliver as part of the forward contract, and multiplied by whatever the number of ounces it has already agreed, that is going to be a substantial amount of money. And in case of Barrick Gold, it came to almost $4 billion, $4 billion, and to pay for or to unwind its short forward position, it went to the equity market and issued seasoned equity or follow on public offer, and it raised this $4 billion to dehedge. Mining company, so no company was entering into any kind of a hedge program. Of course, gold was going on increasing at a almost at a continuous rate. If you know how gold prices was hovering around some 11,000-12,000 around 2010-11, and in Indian rupee, and it is hovering around 27,000-28,000 now. It is almost a I won't say exponential growth, but a consistent growth in the gold price what we are experiencing. So that probably that is the reason why none of the gold mining companies were interested into entering into a hedge contract. But if you if we consider the gold price in dollar terms, the gold price peaked around $1,700 sometime around mid 2012, and 2013 onwards it has gone down, and a couple of days before, as we discussed, it was hovering around $1,300. Now many gold mining companies have started rethinking their ideas about hedging. So they are entering into forward contracts, but they are not terming these are forward contracts. These are different kind of a contracts they are entering, and these contracts are known as streaming contracts. So what are these streaming contracts? Let's let's go to this PPT to understand more. So what exactly is a streaming deal or streaming contract? So a metal stream is an agreement that provides, in exchange for an upfront deposit payment, the right to purchase all or a portion of one or more precious metal produced for a mine at a price determined for the life of the transaction by the purchase agreement. Quite a big sentence, quite a long sentence. It's simple. It's nothing but a project finance kind of a agreement. So let's take this example. Let's see. So this is an example of a streaming contract. So you have a company called Royal Gold, and Mount Milligan is a company which is into gold mining and copper mining based at Toronto, and this Royal Gold has paid $782 million to Mount Milligan, the owner of the Mount Milligan mine, that is Thompson Creek. So to Thompson Creek, Royal Gold has paid $782 million upfront fee before the this particular mine has gone into commercial production, and Mount Milligan has used this $782 million for development of the mine. Now what is the agreement? Once the commercial production starts, Mount Milligan is going to pay gold, not pay any interest amount or anything. It's going to pay gold to Royal Gold, and how many ounces or what amount of gold will be paid by Mount Milligan to Royal Gold? It is 52.25% of the total gold which will be produced by Mount Milligan. So during the mine functioning stage, whatever gold it is going to produce, 52.25% of the total gold will be delivered by Mount Milligan to Royal Gold, and Royal Gold in turn will pay 435 ounce $435 per ounce of gold it receives from Mount Milligan. So this is an example of a streaming deal. Now let's go to this particular slide, some other streaming deals which have been entered. See, if the table shows, there is a company called Silver Wheaton, and who is the stream seller? Stream seller is Glencore. And what is the project? Project is the Antamina silver project, and value is how many million dollar? So Silver Wheaton has paid an upfront fee of $900 million, and this announcement date is 3rd November 2015, and subsequently once the project comes to an end, comes to functional stage, this Antamina silver mine, Glencore is going to deliver silver to Silver Wheaton. And please go to the internet if you want to read more about this particular deal. The public announcement with respect to this streaming deal is available in the internet. You can read that. So this table also shows the other streaming deals which have been signed by buyers and sellers, and if you can see, you have Royal Gold which has entered into Barrick Gold, and Royal Gold also has entered into Tech Resources, and Royal Gold has also entered into New Gold. Now this part I have already explained, example of a streaming, and let's go to let's go to the other varieties of streaming deals which are being signed by the gold mining companies and the stream buyers. Let's this particular slide shows some of the other example. Recall in case of a Mount Milligan mine, the Royal Gold is going to pay 782 million upfront and is going to receive 52.25% of the total gold produced by Mount Milligan in return for $435 an ounce. But Barrick Gold has modified this streaming deal to its advantage. And what is the advantage? Barrick Gold has entered into a streaming deal with the same company, Royal Gold, and Royal Gold is paying $610 million upfront fee. However, Royal Gold is buying gold from Barrick Gold, but not at a fixed price. For up to 550,000 gold, which Barrick Gold is going to deliver to Royal Gold. Royal Gold is going to pay 30% of the spot price, not a fixed price. So if spot price increases, Royal Gold is going to pay a higher price to Barrick Gold, and vice versa. Similarly, beyond this 550,000 ounces, Royal Gold will buy gold from Barrick Gold by paying 60% of the spot price. Similarly, some other streaming deals are being signed by both stream buyer and stream seller, in which the stream sellers, that is the companies which are selling the underlying mining product, so or the gold or silver or copper mining companies, they are including a contract including a clause into the contract in which they have the right to buy back at a certain point of time. So instead of completely giving the more power to the stream buyer, they are keeping some power in their hand, and if they decide to go for a buyback, they can go for buyback depending upon, of course, the underlying movement of the underlying commodity price. And if you see, as per the Financial Post data, mining companies have raised around $4.2 billion from 11 stream sales in 2015 alone. So in the year 2015, 11 mining companies have sold or have entered into stream deals, which is equivalent to $4.2 billion. Now all of us many times we have discussed what is an option contract, and in case of a option contract, exchange traded option contract, you have the underlying as the futures contract, but in case of a OTC contract, the underlying is the gold. So if a gold mining company is fearing that price is going to go down, it can enter into a long put option. Now many gold mining companies are entering into another kind of a option contract, that is known as your barrier option or knock-in option. So what exactly is a knock-in option? So you have a barrier put option. So if you recall a regular put option, in a regular put option, gold mine company will take a long put position, and by entering into the long put position, it has the right to sell gold at a later point of time at a fixed price. Let's say it enters into a long put option at a price of $1,300 and pays a upfront premium of $50 as a put premium. So when it will start incurring profit from this particular option contract, when the gold price is less than 1250. So any range in this company is going to make profit. So this is a typical regular put option contract. Now let's go to what exactly is a barrier option put contract. Barrier option can be many types. So barrier option put can be up and in, it can be down and in, it can up and out, and it can be down and out. So if you go to any textbook which has a chapter on exotic derivatives, exotic option contracts, you will definitely get to see what exactly is a barrier option. So these 4 options I have mentioned with respect to put. You can also have a up and in call option, down and in call option, up and out call option, down and out call option. Here we are talking about put option because the gold mining company is owning the asset and it is fearing that the price is going to go down, and hence it will be entering into the put contract. And in the put contract it will be entering into down and in. So what is the meaning of up and in? Up and in means if price increases, then the put option comes to existence. Down and in means if the spot price decreases, then only the option comes to an existence. Similarly, up and out means if spot price increases, the option becomes option expires. And if down and out, if price falls, the option expires. Now with respect to down and in contract, let's say, so what will be the option features? So what will be the option features? You will have strike price, you will also have a trigger price. So what is the strike and trigger price? This is, let's say, our spot price, 1313 as spot price, and the option, it says that if the price falls to 1270, that is the trigger price. If the price falls to 1270, the option will come into existence with a strike price of 1280. That is, the gold mining company will have the right to sell gold at 1280. Let me repeat, if price falls from the current spot price to 1270, so if price goes down, then only, and reaches 1270, then only the option will come to an existence. And if the option comes to an existence, what is going to be the exercise price? The exercise price is going to be 1280. So many gold companies have entered into this kind of barrier put option. Now this quickly, I have already discussed this. If you see, current gold price is US dollar 1313, trigger price is 1270, exercise price is 1280, and if spot price falls to 1270, then only the option comes into an existence. Suppose the trigger price does not come to 1275, gold price falls down, but it remains at 1270 during the life of the contract, then this contract will never come into existence. Now let's go to collar and gold. So we have already, last class we have already discussed about it. I'll just quickly show you what is a gold mining company. It will be, besides a long put, it will take a short call such that the net premium is 0. So this is the payoff for long put, this is the payoff for short call, and this company will benefit if the gold price is within this range, and company is going to incur loss if it is gold price is above 1600. So between any price less than 1600, this company is going to benefit, in the sense it will be able to sell gold at the prevailing market price. Quickly, I'll just take you through, RBI's gold import rules and regulation. At this point of time, I would like to say that India has only one gold mining company, Kolar Gold, and it does not have any, it does not produce any gold, and it has been non-functional since 2001. India is the largest importer of gold, and India second largest importer of the gold after China, and majority of import happens through authorized agents. So who are the authorized agents? So if you see the details mentioned here, RBI or Government of India has permitted companies such as MMTC, SBI, State Trading Corporation, Kotak Mahindra Bank, ICICI Bank, and Bank of Nova Scotia, etc., to act as a authorized agents. So what are the role of authorized agents? These agents can import gold from overseas suppliers. So as far as the import deal is concerned, these companies can buy the gold outright basis, or they can borrow gold or borrow the gold on a lease basis, and they do not fix the price. Sometimes these authorized agents also import gold on consignment basis. And we know in case of a consignment deal, the ownership of the gold stays with the consignor or the overseas supplier. And so how exactly the gold reaches the jewelers or jewelry houses which use the gold to make gold jewelry? Similarly, this gold jewelry houses or companies, they take gold on lease. They don't buy gold normally. They borrow gold from these authorized agents. Basically, authorized agents borrow gold from the overseas suppliers, and the jewelers borrow gold from these authorized agents. And what is the borrowing rate? The borrowing rate gets determined based on the price prevailing on the day on which the jeweler sells the jewelry. So when AA, please see this one, there's unfixed price basis. When AA imports gold, that is authorized agent imports gold, the ownership of the gold gets transferred from the authorized agent, but the price of the gold is fixed later. So price is not fixed till the jewelry company sells the gold to people like you and me. So so in fact, if you see, the price risk remains with the overseas supplier. And India, all of you know that India has a lot of gold gets smuggled into India through Singapore and Dubai, and because of Government of India's high custom duty, so to evade custom duty, lot of people smuggle gold to India, and it is believed that many jewelry houses buy gold from smuggled gold. So that's why they are very they are very cautious about whenever you ask what is your source of gold you are buying, from where are you buying, the typical answer probably would be हम तो staff है, बाबू को पता है, बाबू से बात करिए. So all those kinds. So it's a what I am driving at is that India's gold market is very opaque. And this particular link, which is gold smuggling in India, this is a beautiful article which was published by Business Today, little dated article in terms of it is 2013, December 8, 2013, but it very nicely explains the modus operandi of how gold smuggling happens in India. So this is this I will be making it available, so if you must read this one. So I will end today's discussion by showing you two cartoons. So this is summarizes the gold smuggling scenario in India. Yeah. So this is your gold smuggling in India. So this is on lighter note. Just to summarize, what is the key lessons? Let me quickly go through. So why gold is considered as a safe haven asset, how gold spot prices arrived, why gold is going into backwardation, because as we understand gold should always be in contango, what are good delivery bars, why and how Barrick Gold unwinded its forward sale of gold, what is trimming and how it is different from forward hedge, and what are knock-in barrier option and how gold mining companies are using this. So with this we come to an end on our discussion on gold. So we will be starting with our discussion on electricity derivative market in the next session. Thanking all of you.